In a market gripped by volatility, many investors seek ways to stay in equities without taking on excess risk. One exchange-traded fund, or ETF, designed specifically for this purpose is the Invesco S&P 500 Low Volatility ETF, ticker SPLV. SPLV focuses on the 100 least volatile stocks in the S&P 500 based on their realized volatility over the past 12 months. Stocks with the lowest historical volatility receive the highest weights, reflecting a classic defensive strategy. The fund tracks the S&P 500 Low Volatility Index and is rebalanced quarterly. As of April 25, 2025, SPLV trades at $71.63, within a 52-week range of $63.38 to $75.43. The ETF currently offers a dividend yield of 1.76% and charges an annual expense ratio of 0.25%. In terms of sector allocation, financials represent approximately 20% of the portfolio, followed by utilities, industrials, consumer staples, and healthcare. Leading holdings include Coca-Cola, Berkshire Hathaway, Republic Services, Atmos Energy, and Marsh & McLennan Companies. The top 10 holdings account for nearly 13% of the fund's $7.6 billion in total assets. From a performance perspective, SPLV has delivered a return of approximately 11.4% over the past year and 2.3% year-to-date in 2025. SPLV's forward price-to-earnings ratio of approximately 21 and price-to-book ratio of 3.62 suggests that investors are willing to pay a premium for stability, a trend that has become increasingly relevant in the current environment. Historically, the fund has shown smaller drawdowns compared to broader indexes during periods of market stress, such as the recent correction in early 2020 and the sell-off in late 2018. It's worth noting that low-volatility ETFs, such as SPLV, typically underperform during sharp market rallies, reflecting their focus on minimizing volatility rather than maximizing returns. For a deeper analysis, you might ask AI platforms such as ChatGPT, Perplexity, or Kahoot. One example of a structured prompt could be, how has SPLV's 3-month and 1-year performance compared to the broader S&P 500? Break it down by sector contributions and assess its risk-adjusted returns using metrics like standard deviation, Sharpe ratio, and maximum drawdown. Citing data from Invesco, Morningstar, and S&P Dow Jones indices will provide a robust foundation. SPLV is not about chasing returns. It is about managing volatility with a disciplined approach. In a market full of surprises, maintaining composure and maintaining exposure can make all the difference. Thank you for watching. For more structured research prompts and actionable investment insights, subscribe to our YouTube channel or visit our free newsletter at www.ai-investing-finance.beehive.com.